Morning, everybody. Good afternoon, good evening. Welcome to the channel if you're new. If you're not new and you came back, thank you. So we're going to try and do an investment video every week of some sort, whether it be stocks, bonds, mutual funds, something. Because this is a wealth building channel, so we need to learn about it. So if you are new, we are going to do some money videos, we're going to do investment videos, we're going to have some study guides for different careers, but we can't do all the careers because some careers you have to actually go and into the field and learn them, like nursing, medical, HVAC, electrical, plumbing, those type of fields. Mostly you need to go out in the field and learn them. You can't learn everything by a video. But some of the techie jobs, I can do study guides for those. Some of the certifications. So you'll see them on this channel. I am not an expert in investments, but if you need an expert, I can hook you up. Everything from my videos, I usually do research on Harvard Business Review, Kiplinger's, or Money Magazine currently. So if you have any other suggestions on what to research, please let me know and I will check it out. But that's where I am right now because I'm not an expert. But I am studying it, so I can learn it and teach it and doing my homework. Well, enough chit-chat. Let's get on with it, right? So we're going to talk about mutual funds, how to determine returns. And I'm going off the screen here in a minute. I can figure out how to get off the screen. Oh, here we go. Okay, I don't know what happened there. Okay, how to determine mutual fund returns. So there's little guarantee of future results, but when we especially mutual funds, past performance is an informative measure. But it's not the only one. The trick is to understand what you're looking at when you scrutinize your performance. And it comes to our attention that some investors are misreading key facets of mutual fund returns. So when you get your expert, you need to set the record straight and get some of the questions together that we received, that the experts received before returns. And as I say in most of my videos, knowledge is power. And I say this quite often, especially with crypto, that I know everybody's scared of it. It does have a lot of risks right now, but in the future, that's the way it's going to be for money. So you need to get educated, and it's the same with all of your investments. Okay, you need to get educated so that you're not afraid to make different decisions and diversify your portfolio. So everything that I'm going to be talking about is mostly the beginning of the year till May 6th. The beginning of May, January to May. Because I'm usually reading these things and they're 2 months. There's a 2-month layover, when they report things. Like we don't really have actual data from July. Okay, this is coming out for July, but they're pulling the data from January to May. That's where they're getting most of these. If I give you any stats, that's where it's coming from. So funds total return, as it appears in fund tables, is the rate of return over a specified period. According to the Securities and Exchange Commission, the return is adjusted for any fees or expenses charged to investors. And this includes annual fees, sales charges, which are called loads, and on shares purchased. So no matter how high the fees are, they've already been accounted for in the returns. And that's why it's important to make sure you're eyeing the right share of class when you're given a fund before you start digging into the returns. So some fund companies have multiple classes. Say there's class A, C, or I. And each one of these charge a different expense ratio and a sales load, which is a sales charge. And this also impacts your return. And a lot of people don't understand these different share classes of the same fund. But they have different returns and their fees can widely vary. So the total return on assumed reinvestments of all dividends and capital gains distributions, as well as sales charges associated with reinvesting payouts. The calculation is designed to help investors compare the performance of funds, even if they have different expense ratios or loads, just to make sure the dates of the returns you scrutinize match up with the comparing rates from the different sources, because timing matters. Make sure you're looking at the return for the share class that you hold. The returns you see listed in the fund's perspective or the website on the fund tracker site, such as Morningstar, assume a lump sum investment on the first day of the reporting period. So if your investment period starts on a different date, or if you're dollar cost averaging, your return will be different. And remember, too, that fund performance numbers assume all dividend, interest, and capital gains distributions were reinvested. So if you took a cash payout instead of reinvesting it, that would also affect your performance. So are funds annualized returns the same as average annual returns? Roughly speaking, that's not exactly. When it comes to periods of longer than 1 year, typically you'll see an annual return, and these are basically the average annual return returned over the period. The actual math between these annual returns is called geometric means, which is more complicated than a simple arithmetic average. It's a 3-year annual return which reflects what you've earned in the fund of the past 3 years. So if you haven't been there for 3 years yet, then it might not be accurate. Annual returns differ from cumulative returns, which are aggregate returns of an investment over time, and they're not often reported. We only occasionally cite them. The cumulative 5 return of Vanguard, for instance, is 87.8, but its annualized 5 years is 13.4. So the cumulative return doesn't average to 13.4 because annual returns capture the effects of compounding, which take into account the change in the value of your investment. And annual returns can be skewed by a great year or two, or mask a mediocre or downright disastrous year in between, which is kind of where we've been for the last couple of years. We are in 2022 right now. And you might think, for instance, that a fund with a great year, 10-year record is a great investment. Century American Select Equity Fund, for instance, which invests in a large company stocks, has been beating the market for 10 years annualized returns of 14.1. But if you look on a closer examination, it has lagged the S&P 500 in 6 years out of the 10 years, out of the 10 calendar years. In short, it's always a good idea to dig into a fund's calendar return and dig into a calendar year returns, because beating its benchmark or similar funds in 8 of the 10 years, it might be a better measure of success than an annual return skewed by 1 or 2 earlier years. So eyeballing your cost basis, the amount you shelled out for a particular investment, and comparing it to the fund's current value may seem a quick, easy way to gauge in performance, but it's best used for tax filing purposes to calculate your capital gains and your losses, and not for gouging your cumulative returns. When a fund pays a distribution in the form of dividend or capital gain, it becomes part of your overall return you've earned in the investment. If those distributions are reinvested, they are added to your cost basis because the payout is used to buy more shares. Think about this example. You invest $10,000 in 2 funds called A and B. After 1 year, the underlying assets in Fund A have increased $1,000, but because no distributions have been made, your cost basis in the fund remains $10,000. Fund B, on the other hand, has not increased in value, but has distributed $1,000 in dividends, which were reinvested, pushing your cost basis up to $11,000. So the 1-year performance of both funds is the same, a 10% return, but it might not seem that way to someone looking at different cost bases of 2 funds. So after tax returns appear in your fund prospect, you cannot ignore them if you hold a fund in a tax advantage account because earnings are tax deferred anyway. So if you own the fund in a taxable account, these returns offer a glimpse of how much the return is left after the taxes are taken out. Be careful about generalizations. The calculation uses the highest individual federal tax rate. It doesn't include your state and local taxes, so it might not even match your situation. A fund's yield is a measure of how much income you might receive from the fund over the course of a year. But like other distributions, the payouts become part of the fund's total return. The 30-day yield will matter most to bond fund investors. If you have $50,000 to invest in a fund with a 30-day yield of 2%, it could provide $1,000 a year in income. The way this particular yield is calculated is designed to allow investors to reliably compare one fund to another. Just make sure you compare yields of the same date with interest rates on the rise, because the bond index of Bloomberg U.S. aggregate bonds sported a 30-day yield of 2.32 in early March of 2022, but by early May of 2022, it had a yield of 3.61. So all of these are just some tips on how to decipher some of these mutual funds and how to determine some with your returns. And hopefully this helped you a little bit. So look for these videos. Please subscribe. Come back. Check out some more. Thank you so much for watching.